Hey guys, welcome back to another stream. So this is Intelligence Maxing, day 54, working on the studying for finals thing. And so I have a final exam today for my financial statements class. Just gonna run through some flashcards, look through the slides, and see what we can do. Oh, my screen froze. Alright, let me change this real quick. There it goes. Okay, nice. Alright, let's get through this. Okay, so the idea of the cash conversion cycle. This is a measure of how quickly a company can turn its inventory into actual cash. And maybe it's also a service, but big idea, how long a company can buy an item to sell that item, and then actually collect cash. So you want this to be as short as possible. That means that you're able to receive cold hard cash quicker for each item you sell. And if you have a negative cash conversion cycle, that means you're actually receiving cash before you're actually even buying the item to sell or producing the item to sell. So you kind of have this negative days to finance, and you're pretty much using your supplier credit to grow your business. This is not right. The time gap represents days where companies would have a negative cash balance. If do not find, if do not obtain external debt or equity financing. Okay. So what is days to financing needed, and how do we calculate it? Days to financing needed is a measurement of kind of the time period or the gap between the cash conversion cycle. So there's really three things you need to think about here. First is the days you need to collect your accounts receivables, days you need to pay off the accounts payable, and then days you need in order to sell off inventory. And what you do is you could take the sum of the accounts receivable and inventory days, and then subtract that by the accounts payable. Okay. What is the difference between corporate strategy and business strategy? Corporate strategy really refers to the idea of strategy for a kind of entire corporate entity that's split up into multiple business entities. In business strategy, that really focuses on kind of a single market or industry or product or service. It's very aligned, very focused, while corporate strategy maybe is split upon different types of focuses. So, it's the entire corporate entity. What is the DuPont equation? What is it mathematically? The DuPont equation is a way of breaking down the return on equity for a company, and it really is composed of three different components: your asset turnover, your margin, and then your leverage. The margin is straightforward. It's net income divided by sales. Asset turnover, sales divided by average total assets. Leverage, average total assets divided by average common equity. Okay. What is the concept of financial leverage in the DuPont analysis? Is it different mathematically compared to the traditional ideas of measuring leverage via liability to equity ratio? So the financial leverage in the DuPont analysis is a bit different from traditional ideas of measuring leverage, usually with a debt to equity ratio, because what we're doing is we're measuring leverage as the average total assets divided by the average common equity. So there might be a bit of a disconnect there, but it is somewhat similarly related. And it comes from the fact that if you were to take the average common equity and then average total assets, that's equal to the average total liabilities divided by average common equity plus average common equity over average common equity. So that just goes to 1. So really all it is in terms of the math, it's the liability to equity ratio plus 1. And liabilities itself does contain non-financing and financing liabilities, so there could be a disconnect there when it comes to the idea of leverage. But at a high level, it's very similar. There is still kind of this built-in indirect assumption or factoring of leverage. Okay. How is return on assets calculated through the lens of the DuPont equation? How does it relate to return on equity? Return on assets, it's just the first two components, your margin and your asset turnover. It's the product between those two. And how does it relate to return on equity? If you scale your return on assets by the leverage, then that will determine your return on equity. What is the concept of asset turnover in the DuPont analysis? What is it mathematically? I think at a high level, the asset turnover really is just a measure of how efficiently are you using your assets to generate sales. And so what you do mathematically is divide sales by your average total assets. So what that number kind of represents, it's a dollar value. It's measured in dollars, I think. And it's a measurement of how many sales are you generating per dollar of assets. Okay, yeah, so our asset turnover, that's good. Where does return on net operating assets? What is it mathematically? Okay, so return on net operating assets is another way of thinking about the DuPont analysis. I think our teacher calls it the advanced DuPont analysis, and it's a way of breaking down your return on equity into two factors: your return on net operating assets and then your non-operating profit. So mathematically, what this really boils down to, it's your operating return or operating income, and you divide that by your operating assets. Okay, so what are those two, right? Operating income is your net income, and then you add back interest expense net of tax. Operating assets, two different ways to define this, and they're both the same. First, you could take common equity, add any financing liabilities like short-term debts, long-term debt, current portions of long-term debt, lease liabilities. Or you could take average total assets and subtract your non-financing liabilities. Non-financing liabilities, accounts payable, income taxes payable, pension liabilities payable. Mathematically, it's just the quotient of taking the operating income, dividing that by the operating assets. So what is this actually saying? This can be thought of as the return that your company is generating based on the equity, based on the assets that are financed by equity. good. That is financed entirely with equity. Interest expense and of taxes, financing liabilities plus common equity. Yeah, the one thing I still don't fully understand is why do we add all of this? I guess we assume that the financing liabilities are also equity. We assume that all financing liabilities make up equity. Okay, what is the advanced DuPont analysis? How does it differ from the traditional DuPont analysis? Yeah, this is what we were talking about before, how traditional DuPont analysis, you can think of it as one way. You're kind of scaling your return on assets by your leverage, and then that'll get you to a return on equity. What the advanced DuPont analysis is, instead of scaling your return on assets, we're going to kind of separate these two into two different things. First is your return on net operating assets. Think of this as the equity finance portion of your business, and then you have your non-operating return. This is your debt finance portion of the business. And I believe non-operating return, this is broken down into really two different things here. First is the spread between your return on net operating assets and then your interest rates, or kind of like the cost of borrowing, the cost of your debt. And then you scale that by the amount of leverage you have. So this can be thought of as the portion of your business in terms of return that's financed by debt. So return on assets. The advanced DuPont analysis makes adjustments to make the impact of leverage more obvious and separate the profitability of a firm's operating assets from the profitability available to equity holders. Right, that's good. What are Porter's two ways of describing a company's strategy? I think what he thinks about, there's two different things, right? So one is differentiation, second is cost leadership. Starting with differentiation, this is the idea that if you create a really good product, people are going to pay a premium for it. I think examples here could be thought of as, if you think of really high luxury brands in the fashion industry, I'm thinking Hermes, Louis Vuitton. These guys have kind of differentiated their product through branding, through craftsmanship, so that people are willing to pay a premium for their products. Right, cost leadership, that's kind of the alternative to differentiation. And this is the idea where consumers are going to buy your product because it has the lowest prices. Big ideas, big strategies for these, I'm thinking of Costco, Sam's Club, these wholesale clubs, compared to other traditional retailers like Kmart's, Walmart's, maybe even grocery stores like Giant or Whole Foods. Or maybe you can make the argument of wholesale clubs compared to department stores like Macy's. I think Costco is currently making clothes under their Kirkland brand, and that's also could be a cost leadership strategy. Okay. What is the non-operating return in the advanced DuPont equation? What is it mathematically? Okay, the non-operating return, this is the idea of how much are you making as a company using the assets that are financed by debts. Mathematically, all it is, it's your leverage multiplied by the spread, where your spread is your return on net operating assets minus the cost of debts or the interest rate for taking on debts. Yeah, so this is really familiar to the equation in the equity to the ROE equation, the equity valuation book. Okay. What is the main idea of turnover ratios? Turnover ratios, all they really are, they're measurements of how quickly a company is either selling or collecting or paying some type of account. I think some big ones to think about here: inventory turnover, accounts receivable turnover, accounts payable turnover. What is the idea of a inventory turnover? What is it mathematically? So I think the idea of inventory turnover, it's a measure of how many times are you selling off your inventory over a period. And so the math kind of helps describe the intuition. What you're doing is you're taking your cost of goods sold and you're dividing that by the beginning or average inventory over the course of the reporting period. And what that kind of gives you, if your number is greater than 1, that means you're cycling through your inventory, your average inventory, at least one time. That means you're selling it off completely and then buying more inventory to replenish it. If it's lower than 1, that means you're still actually selling the existing inventory that you have from the previous period. And if it's really, really high, that means you're actually really good at selling off your inventory, recycling through your inventory, meaning buying more to replenish your stock, and then selling that replenished inventory again. So inventory, you want this to be really, really high. That means that the company is able to sell off a lot of its goods. Here. Assume that a company has $1,000 in total assets for the current year and earns a 20% return on assets. It finances those assets entirely with equity investments, no debt. What is the return on equity using the advanced DuPont? There's a little picture of Royce DuPont here from TikTok, but I don't think it's shown up, so I guess they have this alternative, what do you call this, like the alt tag for an image on HTML that appears. Alright, so I think this question is a bit more simple than it seems. So return on assets, $1,000, has $1,000 on assets, return on assets 20%, that's $200 in profit. The company is entirely financed with equity, so in this case, the return on equity should just be $200 or 20%. Okay, so this is a more complex example that builds off the previous one. It assumes that the company borrows $500 at 7% interest and uses these funds to acquire additional assets yielding the same operating return. So this is a bit more complex. I think what's going on here is you have to think about the non-operating return now and how that might affect the actual net operating return on assets, on the operating assets. Okay. So now we have a 1,000. If we think about the formula, right? So we have 20%. Debt to equity would be 1/2, right? So 1/2, and then spread is about 13%. 13 times 1/2 is 6.5%. 6.5%, you add that to your net operating return, that's 26.5%. Yeah, that's 265, right? Yeah, I think so. So 26.5% multiplied by 1,000, that's $265. So we use kind of the same process of the advanced DuPont here, but in this case, I believe in the answer to this, I ended up just combining these two and then factoring in the interest. Right. So this is an alternative way to think about the return on equity. Porter's two ways of describing company strategy. You have cost leadership, differentiation, create new products that people are willing to pay a premium for. Cost leadership, create or sell goods and services in which you provide the lowest cost. Okay, so I think that's good. I'm gonna go use the bathroom real quick and then come back. I'm gonna take a look at some of the slides again. I don't know if it's worth it to make any more flashcards. And I think our teacher gave us a list of some topics to really focus on. I think that's probably what I'm gonna try to do then. So I'll be back in a sec. Alright, made it back. Let's see. So I think what I'm gonna do now, alright, take a look at what I wrote down first in terms of Eli Lilly notes. There we go, okay. So mix of ratios, DuPont's, last in, first out. I think that is kind of like a stack. If you were to think about it in computer science term, first in, first out is a queue. Okay, so we've kind of gone through this. I think that's okay. Capitalizing R&D. That's probably going to be a big one. And yeah, I don't know if we really need to think about the tax stuff. It's probably very specific. I'm going to hope that we don't talk about it because I'm not too good at that stuff. Okay, let's see, R&D, red flags. Okay, so I think this is probably the big thing we should focus on. This example of trying to capitalize R&D for Meta. Okay, so it seems like what is going on here is you have these different R&D expenses showing up on the income statement from 2017 to 2021. And this is asking us to capitalize R&D the end of each year, amortize it over a 5-year period. And then also, if R&D costs had been capitalized and amortized, what would adjusted net income be for fiscal 2021? How would these accounting adjustments affect the DuPont ratios? Okay, so what they do is they just mark the actual cost as some type of R&D asset on the balance sheet in the year in which it was occurred, and then amortized it on a 5-year life to 0. So then I believe you get to this 53.34, okay, and if R&D costs had been capitalized, so the adjusted net income for fiscal 2021, I think what you would want to do is you want to add back the R&D cost of 24.7 to net income. Maybe there's also a tax effect here too, although I don't think it's going to be that complex. But basically, I think you add this back, and then you subtract the amortization of all of the previous year's R&D. Oh, so this is the amortization expense. Okay, so this is the tax, I think, actually. Effective tax rate. Okay. So why do we multiply by 1 minus 0.16? I think the adjusted net income. No, it's like a gift.
Oh, I thought you said it was your parents. No. Oh, okay. Yeah, I was like,
So why do we do this, right? Let me think. So this is kind of the difference, aka the benefits. But we have to multiply by 1 minus the tax rate. This is the same thing as taking the benefit and subtracting by the benefit times the tax rate. Oh, maybe it's the idea that this benefit also gets taxed as well. Because at the end of the day, we're still looking at net income. So just adding it back wouldn't make any sense. Okay, I think this makes more sense because what this is really saying is, all right, you have the benefit. What I mean by benefit here is the lower expense in 2021 compared to the reported expense, so your net income is going to be higher if you were to capitalize R&D. But this benefits still you have to pay taxes on it, and so in order to account for that, you just have to multiply by 1 minus the tax rate to subtract the amount of taxes you have to pay for this benefit, and then you can just add it to your adjusted net income. And you don't need to worry about adding this back either, I don't think. Yeah. Current equity, okay, identifying red flags, 124.9 billion. Unadjusted equity is 53.34 plus cumulative tax after savings. Oh, so this is the common equity. Oh, so you have to add your earnings here. Seems like, wait. Any assets, okay. I'm curious to see why. I'm curious on why you actually need to multiply by the tax rate here. By 219. So 219 is the average total assets. Divide that by average common equity. So we have to add. Yeah, right. I understand. Maybe that makes more sense that we add this book value of R&D assets. We're just assuming that's financed by equity, but then multiplying by 1 minus 0.16. Why do we need to multiply by the tax rates is what I'm confused on. So when capitalizing R&D, why should I multiply by 1 minus tax rates for the adjusted common equity? Yeah, I don't think this is could be a ChatGPT problem too. Okay, tax. Adjusted equity. Okay, wait a minute. Let's see what this says. this is 124.
But it's like,
Wait, let's see.
no, to be fair, we're very like Catholic in here, so it's like a very traditional, like almost like, yeah, like a Catholic wedding. But I remember in theirs, I think it has to be similar, but they did like a traditional Caribbean dance, like the daughter and
16 okay.
but it was like her mom died.
Alright, let me see if I can just breeze through this.
Like she grew up dancing it, and then the dad like was also a big dancer, but not much. And then like you know years later, and so like the parents there, and they're like, oh, let's just do it. And that was like the daughter brought me dance, and they're just like good. Yeah.
Operating expenses create no assets and affect capital only indirectly through retained earnings.
I mean, you and your brother also have a relationship, but I feel like your guys' is like wholesome, whereas theirs is much. Kick.
Forcing firms to expense earnings seems slightly to the
I realized we were just like standing, and I was like, oh.
It's not one that can be used.
Josh, are you
Yeah, I'm gonna save this actually. This is a pretty good article. Just gonna add this here. Okay, this is interesting. The after-tax effects will be even larger because the tax benefits has to be deferred until future periods. Okay. So I'm doing my stock pitch on Eli Lilly, so it's a pharmaceutical company. And now I'm thinking about this. It seems like we're probably going to have to give this a try, an exercise, capitalizing the R&D expenses and seeing how that might impact. Our valuation. So Damodaran, he just actually adds the research assets to the book value of equity and capital. Not entirely sure what he means by capital here, but he isn't multiplying by 1 minus the tax rate, which is interesting. Minus the 10. Wait, why do we do twice? Okay, yeah, this doesn't really provide a helpful appreciation, free cash flow. Yeah, not entirely sure. I think I'll just go off the slides for now. And it is open book, which is nice, so I can have these slides on when I end up doing my exam. Alright, what is the other thing that we have to do? Polymer capitalizing R&D. I think maybe LIFO is probably going to be a big one. And also the PP&E ratios. So maybe it'll be helpful to understand which problems. PP&E and inventory. Okay. I think this is probably going to be good. Oh, and it'll be good for me to have all of these pulled up to salvage appreciation rates. So we have accelerated versus straight line depreciation. Two times that, so it'd be 40%. Ooh, LIFO reserve. Okay. Yeah, so I'm gonna come back to this, but I do have to go. I think after my class, then I have the exam, and then maybe I'll stream again, talk about what I thought about it, and then maybe work on the Eli Lilly thing for a little bit, and also my other project for my deep learning class. So there's a lot to do today, and probably catch you guys in the next one. Thanks for tuning in. I'll see you for now.